This is Wall Street. Where corporate empires rise and fall. Every day, billions of dollars move through capital markets. IPOs, M&As, leveraged buyouts, stock buybacks, these aren't just financial transactions, they are power plays that define the world of business. Corporate finance isn't just about managing money, it's about raising capital, making those billion-dollar deals and shaping the future of business. And the CMAs who master this game don't just track numbers, they build empires. Every investor, CEO, and financial strategist asks one question: how much risk am I willing to take for the return I want? Simple Wall Street formula: higher risk, higher return. For example, Tesla versus Coca-Cola. One is a high risk, high volatility bet. The other is a stable cash flowing machine. An important question in corporate finance is how to raise capital to fund growth. The first option, of course, is debt financing. Leverage is powerful. Borrowing money at low interest rates can fuel expansion, but too much debt can cripple a company. For example, in its early years, Tesla borrowed billions through bond sales and convertible debt.
Government came through with almost $500 million in terms of a loan to your company
to finance gigafactories, R&D, and electric vehicle production expansion. Many analysts feared Tesla was taking on too much debt without profits.
This man, Elon Musk, owes more people more money than ever in the history of a startup business.
But as revenue skyrocketed, Tesla repaid its obligations and emerged stronger. By 2023, Tesla had turned from a high-risk, debt-heavy company to a cash-rich powerhouse. The second option, of course, is equity financing. Issuing stocks is a great way to raise capital, but of course, it dilutes ownership. Case study is Facebook and also Uber, who raised billions in private funding before going public, maximizing their valuation.
Uber might have had a controversial November in the press, but there doesn't seem to have been much controversy among investors. CEO Travis Kalanick announcing today in a blog post that the company raised $1.2 billion.
Now, the exciting game in corporate finance is mergers and acquisitions. On Wall Street, bigger is always better. M&As are how companies expand, dominate, and sometimes crush competition. There have been some legendary M&A wins. For example, Disney's acquisition of Pixar, Marvel, Lucasfilm to build a global entertainment empire.
We paid over $7 billion for Pixar. Disney has agreed to acquire Marvel Entertainment. The Walt Disney Company is acquiring Lucasfilm.
Pixar was the creator of Toy Story and Cars. Marvel owns Marvel heroes like Spider-Man and Iron Man. And Lucasfilm, they own the Star Wars franchise. And now Disney owns them all. Facebook's acquisition of Instagram for $1 billion in 2012 looked expensive.
Facebook have paid
$1 billion was the first high-profile acquisition.
Today, it seems like a steal. Google's acquisition of YouTube in 2006 for $1.65 billion.
Well, in the last few minutes, Google, the world's largest internet search company, has agreed to buy YouTube. They're paying $1.65 billion, £900 million, which is an astonishing sum of money when you consider that YouTube was only created in February of last year.
Web giant Google will pay $1.6 billion to gobble up YouTube, a company created over dinner by 20-somethings Steve Chen and Chad Hurley, as a way to share their home movies.
The most compelling part of this is being able to really concentrate on features and functionality for the community.
And this is great. Two kings have gotten together, and we're going to be able to provide you an even better service and build even more innovative features for you.
Seemed like a risky bet back then. But today, YouTube dominates online video, generating billions in annual revenue and is now worth hundreds of billions of dollars. But then there are also the M&A disasters, when deals go wrong. Let's say Microsoft's acquisition of Nokia.
Lightning fast changes in technology are slaying giants and remaking some of the world's biggest corporations. It happened again today. Microsoft said it's buying Nokia's line of mobile phones in a deal worth more than $7 billion.
Which was more than $7 billion of write-off. So they tried to compete with Apple's iPhone, but failed miserably. Verizon acquired Yahoo and AOL for billions.
Verizon has agreed to buy Yahoo for a whopping $4.8 billion.
And later sold these outdated internet brands for much lesser. And then we have hostile takeovers, the Wall Street war zone. So we saw Elon Musk take control of Twitter with aggressive financing and reshaping the company overnight.
Elon Musk has now completed his $44 billion deal to buy Twitter after months of legal battles.
Well, I did try to exit the deal and they wouldn't let me. I mean, it was a funny situation where when I first proposed the acquisition, they said, hell no. They adopted a poison pill, basically saying they'd rather die than be acquired. Like they'd rather chew on cyanide. But then a few months later, they're like basically have a gun to my head saying, no, you must acquire us. I mean, that's quite a change.
It is quite a change. But you seem to think, I can figure out a way out of this until finally, I guess you realized I can't.
It was made clear to me that the decision would not come down in my favor legally.
Yeah.
Corporate finance isn't about playing it safe. It's about making the right moves at the right time, whether it's raising capital, making billion-dollar acquisitions, or maximizing shareholder value. CMAs drive the biggest financial decisions. Do you have what it takes to play the Wall Street game?